All right, guys, I know it's hard to imagine, but the Nasdaq was down today. This is shocking for everybody involved, especially me. I didn't think the Nasdaq could go down ever. Interestingly enough, look at this. The Dow was up today. The Nasdaq was down over 2% today, and the S&P was down 0.7. Now, if you notice in the last 6-7 months, since this big rip in the Nasdaq has far outpaced the S&P. Why? Because the tech-heavy Nasdaq has really flown because of AI. This whole AI, dare I say, bubble has really caused all these stocks to skyrocket. And as I've said in the past, when you have a massive run-up in stocks that are irrational, when you finally have a decrease, they're going to be correcting a lot more than the other ones. So if this trend continues, which is a big F, we have not felt this in a while. If this Nasdaq fall continues, it will far outpace the S&P fall based on history and based on just logic. When something goes up just like when something goes down very fast, then when things have to rebound, they'll probably be the first ones to rebound as long as there's some good fundamentals behind it. Now, to explain the Dow, I don't have the list of Dow 30, but remember, the Dow is not a market cap-based index. What does that mean? That means if you look at the S&P and Nasdaq, if a company in the S&P has a $100 billion market cap and there's another one in the S&P with $10 billion, this one matters 10 times more. Why? $100 billion market cap versus 10. But in the Dow, if their market cap is 100 billion and the other one's 10 billion, but the stock price is the same, the Dow they value them exactly the same. If you're scratching your head, you should. It's completely asinine and stupid. That's why I never look at the Dow. I look at the Dow. The only reason I even mention the Dow is when I'm correcting people and they say, hey, how's the market doing? How's the Dow? I go, hey, don't talk to me about the Dow. Only S&P, only the Nasdaq. But the big news today, our good friend Tesla was down 10% today. Why? They reported earnings last night. They beat on revenue and they beat on profit. But they're down 10% today. Now, I didn't look to see exactly the reason. Let's go look at the news and see why that's happening. All of these are today. And I'm not seeing a reason for it. Now, could there be a reason for it? Of course, there's probably a reason for it. But at the end of the day, it also could just be the fact that people get a little worn out. When something jumps up that much, remember, year to date, even with the fall, they're up 145% year to date. That's a pretty big increase. The low was just January 6th of this year. $101 a share. $101 a share. It is now at 263, 262, hit a high of, what was the high in the last 6 months? Year to date, 285. That's a pretty big increase, guys. And these are the things that when there's a lot of euphoria, these things happen. Let's look at NVIDIA, another top NASDAQ stock. Year to date, up 218%. Today was down 3.3%. Nothing major, but all-time highs. Now, here's the list of the NASDAQ 100. And these are the top 10 companies. Now, Google's in here twice because of Class A versus Class B shares. But down. This is why you're down 2%. This is why it took until stock number 10, PepsiCo, to be up today. And in the top 13, oh yeah, Netflix was also down 9% today. And you also had AMD down 5% today. All right, we need some market cap index. The bigger the market cap, the more the weighting. This is what caused the big fall. All right, look at companies like Microsoft. Microsoft's up big lately. Apple, did it hit 2? I don't think it hit 200, but these are big companies, guys. And I've said before, and I'll say it again. I think Apple's going to be the last one to have its final fall. People are going to look at Apple. There's a meme I saw on the internet where that building is falling and it's being held up by a piece of wood. And it says, Apple's the piece of wood and the building falling is the stock market. Obviously, that's not the case currently, but last year it was because Apple wasn't falling like the rest of the market. Apple was holding the market up. With such a big market cap, it can hold the market up big time. All right? That's the interesting part. What's interesting here is Apple's bigger than Microsoft, yet it's listed second. I wonder why that is. Very interesting. Oh, that's why. This is done based on Why is the weighting? Oh, interesting. There's a higher weight to Microsoft. Interesting. Okay. So back to the current market. If this kind of stuff scares you and you have individual stocks, you just need to follow our channel. And the reason being is we sit here and we like to look at companies as the present value of all future cash flow. And when you buy a stock, you're buying a piece of business. If that doesn't make sense to you, all the more reason why you need to subscribe. All it says is when I buy a share of Microsoft, I am now an owner of Microsoft. And Microsoft, as long as I pay a reasonable price for the company, as long as Microsoft grows, I will probably do well along with it. But the key part is paying a reasonable price for the company. All right. Now, another thing I ask you to do is I'm very active on the Twitter machine at Paul Gabriel. So follow me there. I do a lot of comments every single day. I just put a poll out on do stocks go up? And the two options are yes, stocks go up, only go up. And 2, Paul, you're stupid, stocks only go up. So it just might be me being funny, but I do engage a lot with people. And I like talking about these kind of investment ideas. People will comment and say, hey, and I try to engage as much as I can with very fruitful comments. If you have a very engaging, good comment, I love to interact with it because I really like discussing investing. Investing is a lot of fun for me. And even when things are euphoric and crazy and I have a lot of short positions out there, I have a lot of long-term short positions. Okay, I have no problem with that. I'm here to be patient. And I'm buying stocks. I have 12 companies that I own. And if you watch our videos, I will tell you which ones they are. But again, we're trying to teach a process here. I'm not just trying to say, go buy the stock. Because I'm programmed differently. And what makes sense to me will not make sense to you. What makes sense to you will not make sense to me. You're programmed differently as well. However, the process in which I teach about value investing is fundamentally what I want you to take away from this channel. I want you to be able to look at investment and say, okay, what cash flow do I expect to get from this investment over long periods of time? And what kind of price can I pay to get a good return on that capital, on that cash flow? I don't know. It's different for everybody. Mo and I talk all the time. We did a video today which we looked at Microsoft as a way of teaching people. And I sat there and said to Mo, hey, he said he wanted a 10% return on Microsoft on our lowest assumptions. And I said, hey, there are people out there who probably want 7.5 or 8% return because everybody's situation is different. And I'm age 42. And when I'm 85, my decisions will be a lot different than today. When Warren Buffett was 42, he was making a lot different investments than him today at 92. Very, very different investments. And that's what I want this channel to be able to open up for you. A different way of thinking. That's the whole key. Now, are there right and wrong ways of thinking? Yes, because if you don't believe that when you buy a stock, you're buying a piece of a business, then you should only own ETFs and put them away and never look at them and just keep doing it every single month. But if it does make sense to you that when you buy a stock, you're buying a piece of a business and you're buying a future cash flow, there's a way for you to find stocks to buy individually. But it's the emotional part's the hardest part. That's what I'm here to teach people and to give them insight in the way I think, okay? There's other stocks we've talked about in the past, and the last 6-7 months have not been good for my investment portfolio, and guess how I sleep at night? Just like this. It doesn't bother me, because I believe long-term that if you pay irrational prices for companies, I look at NVIDIA, and I see a $1 trillion company that generates $25 billion in revenue selling for 43 times sales, and 234 times profit and say that's irrational. If all of what I said to you right there was way over your head, subscribe to the channel. Because if you watch enough videos, 4, 5, 6 videos, you will understand what I mean here. This is all irrational. Crazy. Now, and funny thing is, NVIDIA is a very profitable company. They've averaged over $5.2 billion in the last 5 years of net income. They've averaged over $5 billion in cash flow. But it is possible to overpay for a good thing. And that's what I'm here to teach you. I'm here to tell you and teach you, and you probably understand that, you definitely understand that it's possible to overpay for a good thing. Absolutely everybody in this world understands that. Nobody can deny that. But when we get stuck emotionally because we see this happen to stocks, keep going up and up and up, it's hard to pull away from that. The stock market's the only place in the world in which we like it more when things are more expensive and we hate it more when things are cheaper. Everything else we buy, we want it to be cheaper, except for our investments for some reason. So again, guys, follow the channel, follow me on Twitter. I'm very active, and we're going to teach. We're here to just talk about our ideas, and if they make sense to you, you're going to learn a lot. If they don't make sense to you, no problem. I don't blame you. Maybe someday it will, maybe someday it won't, and you could just be a totally different kind of ETF saver, and that's a wonderful place to be. But even if you want to learn the emotional side of things, this is a great place to be, because even if you only buy ETFs, you still need to emotionally be able to see your account go down by 40, 50% every decade or two in order to be able to use that as a buying opportunity. Thank you very much for your time.